Good morning, ladies and gentlemen. Thank you for joining us today. My name is John West, and I'm Head of Client Strategies at Research Affiliates, and it's my pleasure to host today's webinar, How Can Smart Beta Go Horribly Wrong? Research Affiliates' mission is to bring transformative insights and products to the investment community for the benefit of investors. And it's in this spirit that we recently published our research on factor valuations earlier this year. And although the article has gained broad readership and a wide degree of media coverage, we find that many of its key insights have been misunderstood or at times entirely lost. And so let me be unambiguously clear. Research Affiliates is not suggesting that investors abandon smart beta products. We continue to believe that smart beta strategies will play a vital role in investment portfolios moving forward. Instead, we advise investors to look before they leap. And it's my honor to introduce Rob Arnott, who's going to tell us exactly where investors should look and what sort of things they should look for before implementing smart beta allocations. Rob's not only my friend and colleague, but he's the co-founder, chairman, and CEO of Research Affiliates. Again, we'll allot the last 10 to 15 minutes of the webinar for Rob to address questions and answers. Now, why don't I turn it over to Rob?
Thank you very much, John. What I'd like to do is to begin by making a very, very simple observation, and that is performance chasing is probably the single biggest source of investor pain and losses in our industry. And performance chasing is rampant. With the rise in portfolio turnover over the last half century from a few dozen % turnover per year to literally hundreds of % turnover per year, performance chasing is rampant. Academics, when they're looking to publish a journal article in order to earn tenure, what better way to do that than to find a factor of returns that has a terrific historical result that is demonstrably independent of the classic Fama French factors and therefore can be shown to be a new factor. So the factor hunt has become a central element of the academic finance world. Cam Harvey in 2013 documented that 252 factors had already been published by the end of 2012. Our best estimate at this point is that the total is now north of 450. Good gracious, 450 different factors, and they all work? Good gracious. Practitioners, when they're designing products, are looking for product ideas with the best historical performance. Asset owners and investors are looking for strategies and managers and asset classes with the best historical performance. The problem is simple. Past is not prologue. Past performance is past performance. And if that past performance was built on a foundation of rising valuation multiples, watch out. The factor, the strategy, the manager has enjoyed a tailwind from rising valuation multiples, and that tailwind can be mistaken for persistent alpha. Selection bias also enters into the picture. If an academic looks at 10 variants of a single factor, what's likely to be published? The one or two best of the roster, best defined historically in terms of past performance. So there's selection bias, there's data mining, there's the mistaking of rising valuations for persistent alpha. We think academia and the practitioner community should decompose alpha into situational alpha, attributable to rising relative valuation, beating the market by becoming more expensive relative to the market, as compared with structural alpha, the valuation adjusted alpha. Now, there's a lot of different ways to construct valuation adjusted alpha. Each of them has their own strengths and weaknesses. We choose one in this paper, and it is not the only possible way to do this. Alpha that's due to changes in relative valuation is in the very long run likely to be mean reverting, in fact demonstrably so, and should average roughly zero in the long run. Caveat, when I say long run here, I mean really long run. Changing valuations can contribute significantly to the performance of a strategy or a factor or an asset class in the short run, which can actually mean decades. In our paper, we use the illustrative example of U.S. equities in the second half of the 20th century, which produced an 8% real return. Well, 4% of the 8 came from rising price-to-dividend ratios, tumbling dividend yields as the yield went from 8% to 1% in a half century. Net of the rise in relative value in valuation levels, the real return on stocks was 4%, not 8. Well, that's a daunting change. And it set us up for expectations at the start of this century that were wildly out of alignment with what the markets could plausibly deliver. So alpha adjusted for change in relative valuation is a good measure of unconditional expected return for a strategy or a factor, and I would readily acknowledge that there are multiple ways to adjust for changes in relative valuation. We use price to book in our decomposition of returns. Doesn't have to be that. One can use multiple measures. One can use individual measures. We use price to book because that's the norm in academia and in factor land. In the second and third paper in this series, we'll actually be using a blend. But each measure has its own limitations, and the blend winds up being softening some of those limitations. The biggest drawback of price to book is that it's also used as the basis for one of the core factors, the value factor, the classic fameux French value factor. And so if it's used for selection and also used for measurement, you have a little bit of a conflict there. Let's turn to the first exhibit, graphic exhibit in our paper. And this is an interesting exhibit, so I'm going to spend a fair amount of time on it. The blue line shows the performance of the classic fameux French HML value versus growth factor. What is it? It's defined based on finding the 30% cheapest stocks in the market, based on price to book value, and then capitalization weighting that portfolio. That's your value portfolio. Find the 30% most expensive stocks by price to book value, and capitalization weight that portfolio. That's your growth portfolio. The difference in returns between the two portfolios, think of it as a long-short portfolio, is the return on the value factor. It's the blue line. And you can see it goes from 1 to between 3 and 4 over the past almost half century. Well, that's pretty cool. That means that if you invested in value, you wound up 3 to 4 times as wealthy as if you invested in growth. Terrific. So let's just be value investors. But wait a minute, not so simple. The path is bumpy. You can see we have a surge in performance between A and B, notably the last 5 years of that, which was 1973 to 77. Tremendous performance for value relative to growth. We then can see from about 1989 till 2000 that the value investor underperformed growth by such a wide margin that they would have lost half their value relative to the growth investor. Then they would have doubled again between 2000 and 2007, actually tripled. And then they would have fallen almost in half from 2007 to date. This past decade has, everyone knows, been utterly brutal for value managers. Well, where this gets interesting is the green line. And to the best of my knowledge, the green line hasn't been shown up in any of the analysis of factors in the history of factor development. I asked Cam Harvey a few weeks ago, of the 400 plus factors that have been published, was he aware of any of the 400 that had asked the question, is my factor newly expensive? Has my factor performed well by dint of becoming more expensive? So the green line traces the relative valuation of the value portfolio versus the growth portfolio. The end point on the chart, this is also on a log scale, but it's on the right. The end point on the chart, E, shows a level of about 0.14. What does that mean? That means that the value portfolio is at 1/7 the price to book value of the growth portfolio. Growth is 7 times as expensive as value. Look back at the point B. It was around 0.3 on the right scale, and that means that in 1977, growth was priced about 3 times the price of value. Well, that sounds like a big spread. It's not. The historic norm is about 5-1. It was at 3-1 back in 77. Now, what's special about 1977? That's when Basu published his seminal paper identifying the value factor. He's often credited as the person who discovered the value factor. Isn't that interesting? It was discovered after a 5-year surge in performance in which value had completely stomped growth, but it completely stomped growth by dint of becoming massively more expensive. Note that going from B to E, value hasn't done a whole lot for investors in the 40 years since it was first discovered. Good gracious. But also note that from B to E, it's gone from being priced at 1/3 the valuation of growth to 1/7 the valuation of growth. I'd like to draw your attention to 2 other things on this graph that I think are interesting. Firstly, notice that the ups and downs on the green graph and the ups and downs on the blue graph are joined at the hip. What this means is that short-term performance for value is heavily dominated by whether value is getting richer or cheaper. So what we notice is that when the blue line takes a nosedive, almost without exception, it's because the green line is tumbling, value is getting cheaper. That's a buy, not a sell. Isn't that interesting? When investors were bailing out of value strategies, trying to find anything other than value in 1999 and 2000, they were missing the best opportunity to buy value of that last half century. It's also interesting to note what we call the wedge. If the blue line is going up relative to the green line, we view that as structural alpha. How you measure structural alpha is something that's going to be sorted out in the years ahead and will be subject to active debate. But basically, it's this wedge. Now, we went through this same analysis on a whole array of factors. We show 4 of the most popular ones here. On the upper left, up minus down, momentum. Blue line is the performance of momentum. My goodness, it's been a wonderful factor. Owning a high momentum strategy would have left you 7 times as wealthy as owning a low momentum strategy if the trading costs were free, if you had the staying power through the occasionally daunting momentum crashes, but it's a powerful factor. Note also the wedge. The wedge is big. Note also that the green line and the blue line do seem disconnected. It's not joined at the hip the way it is with value. Why is that? Is it that momentum strategies are wildly volatile? No, it's that momentum strategies are rapidly changing their composition and sometimes suggesting that we should favor the high multiple companies. Note the range over on the right. High momentum stocks are usually priced at somewhere between 1 and 3 times the value of the low momentum strategies. Sometimes it gets above 4 times. Sometimes it gets below 1 or even below 0.75, meaning that momentum is suggesting that we load up on value stocks. When is momentum going to suggest value? When the growth stocks are starting to crater and the value stocks are starting to turn. I draw your attention to another self-evident fact on this graph. The peaks on the blue line just before momentum crashes are pretty reliably also peaks on the green line. What this means is that when momentum is telling you to chase bubble stocks, it's time to turn off the momentum factor. When momentum is telling us to buy into cheap stocks because they are turning, because their momentum is good, it's time to ramp up our focus on momentum. Note also over on the upper right, small versus large, those two lines are joined at the hip. Once again, you've got a wedge. The blue line goes up 3-to-1. The green line goes up modestly. Small is more richly priced than it was at the start of this period, but not more richly priced than the historic average. The green line sometimes strays up to 1 or just higher. What does that mean? Small cap is priced at a premium multiple to large cap. When that happens, watch out. There are other times when it gets down to 0.3, when large cap is priced at 3 times the multiple of small cap. When you get to that condition, give up on the large cap and load up on the small cap, or at least tilt your portfolio that direction. Low beta versus high beta on the lower left tells us that the much touted low beta strategies and low vol strategies have enjoyed a heck of a tailwind from rising valuation multiples. Now, like the momentum strategy, these two lines are not joined at the hip. They don't go up and down in perfect synchrony. But what you can see is that when low beta stocks are priced at a large premium to high beta stocks, they generally perform badly. The lower right is one of many quality-related factors. It's high profit margin companies versus low margin companies. And each of these is constructed based on constructing a long portfolio with the desirable attribute, 30% of the market cap weighted, and a short portfolio, the undesirable attribute, 30% of the market cap weighted. The profitable versus unprofitable, well, those two lines are joined at the hip, and oh my goodness, as with low beta versus high beta, there's no wedge. Yes, you've done better with high profit margin companies. Yes, you've done better with low beta companies. But that appears to have been largely a situational alpha associated with rising valuation multiples. Our paper warns against mistaking rising valuation multiples for alpha, for sustainable alpha. It's not. We go back historically and take half a dozen representative factors and ask, what's the long-term return? 2 of these are highly significant, 95% confidence, momentum, and illiquidity. 2 are moderately significant, value and small cap. Those are the granddaddies of them. Those were the Fama French factors. 2 of them are not statistically significant, low beta and gross profitability. We then look at the return from changing valuation. Now, this is simply a measure of the rise in valuation multiples relative to the market for these factors. So value has gotten cheaper relative to the market by an average of 0.8% per year compounded. So if the change in valuation multiples is situational alpha, then the structural alpha for value would be quite large. What's interesting to note is that when you take out the effects of changing valuations, sometimes the statistical significance of the alpha goes up. The changes in valuation explain a lot of what's going on in changes in returns for value and for small cap. They're joined at the hip. So subtracting the relative valuation change of the last 50 years is probably a good way to get a handle on the structural alpha associated with value and small cap. And lo and behold, value turns out to be the most powerful statistically once we net that out. Illiquidity and gross profitability are two others where the relative valuation and the relative performance are joined at the hip. Momentum and low beta less so. So we'd have less confidence in this simple subtraction for momentum and low beta, but we would draw attention to the fact that in the case of low beta, the valuations have gone up considerably, so some of that 1.73% historical excess return is not structural alpha. It's situational alpha from rising valuations. We can look at the work in a different fashion, and that's to look at the historical linkage between relative valuation and subsequent return. So here's the value factor. On the horizontal axis, you can see it ranges from 0.08 to 0.32. What does that mean? It means that value is priced at 8% of the value of growth. Growth's at 12 times the pricing multiple of value at the low end. And at the high end, it's priced at 3 to 1. Growth is priced at 3 times the multiple of value. We then look at the subsequent 5-year return. Subsequent 5-year return and the valuation ratio are pretty closely aligned. It's not a high statistical significance, but directionally it makes good sense. And what we can see here is that when the valuation ratios get cheap, you don't often lose money by going into value. Where are we now? The blue dot. If history is a guide, there are no circumstances where value is cheaper than it is today and where value failed to add value over the next 5 years. In fact, none below 0.15 where that occurred. Well, that's awfully reassuring. Momentum has a lot more scatter. The fit's a lot worse. Subsequent 5-year returns aren't very meaningful when it comes to a factor that is changing its composition every month. And yet, the linkage is statistically significant. When momentum is saying that you should load up on inexpensive companies, the 5-year return on momentum is pretty good. When it's saying load up on the high multiple companies, the 5-year return on momentum is not very good. Now we can actually look at short-term alpha. What's the linkage between relative valuation and the immediately subsequent relative returns of high momentum versus low momentum stocks? And when you've got a factor that's changing its composition monthly, this is the kind of analysis that makes the more sense. And oh my goodness, what a strong relationship. What this suggests is that momentum is currently recommending relatively high-priced companies relative to the low momentum stocks. And so for the moment, it would suggest that forward-looking expectational alpha would be a little depressed relative to history, but still pretty good. Small versus large, T-statistic is off the charts. The long-short portfolio is suggesting that the small cap stocks are priced at a pretty good discount relative to large cap at the moment. Illiquid versus liquid, another significant relationship. Note, in every case, there's this downward slope that's pretty strong. And low beta is the one and only one where the statistical significance largely disappears. But even here, the relationship right now is so stretched that even a weak relationship would seem to suggest a risk of negative alpha. That's what we mean when we say, how can smart beta go horribly wrong? You buy into a factor thinking that the historical 3% alpha is going to be an engine for future returns, but lo and behold, part of that 3% is rising valuation multiples, and those rising valuation multiples leave you right now with lofty valuations and with depressed future returns. If you're buying a strategy expecting a 3% alpha and you get a minus 3% alpha, that is a strategy going horribly wrong. Profitable versus unprofitable, the most stretched relationship here. It's certainly not the only measure of quality, and price to book is certainly not the only measure of relative valuation. but we're well in the top decile of historical valuations at a level where if history is a good gauge, profitable companies should underperform unprofitable, lower margin companies by nearly 5% per annum. That's what we mean by horribly wrong. This graph, I think, tells an interesting story. Each of the orange bars shows the historical range, 5th percentile to 95th percentile. So the bottom of each bar tells you the relative valuation of the long and short portfolio, the top of the bar being 95th percentile, middle of the top decile, the bottom dot, 5th percentile, middle of the bottom decile. The arrow starts at the median and ends where we are today. So profitability historically commands a premium multiple of 2 to 4 times the low margin companies. And the historic median is about 2.5 times. We're closer to 4 now. We're in the top decile. Low beta, we're in the top decile. 4 of these 6 factors were above historic norms. 3 were in the top decile. 3 of the factors are trading cheap relative to historic norms, 1 very close to historic norms, 1 moderately cheap, and 1 value in the bottom decile, cheapest decile. So if we draw attention in this table to the middle column tells us what percentile we're in. The ones that are close to the middle of the range, I don't want to worry too much about those. The ones that are extremes, value 6th percentile by historical standards, that's cheap. Don't flee value strategies just because they've had a rough decade. It's time to double down. Low beta strategies and high profit margin strategies, increasingly popular because they help people diversify away from value. Big mistake. Diversifying away from value is not a good move right now. I'm not suggesting taking huge heroic bets, but it's a huge heroic bet to abandon value and chase low beta and high profit margin companies at a time when the former is cheap and the latter are expensive. We did the same thing internationally, and this did not appear in the first paper. It will appear in the second. We looked at developed ex-US markets going back to 1982 and emerging markets going back to 1996. We find the value effect is alive and well, developed ex-US and in emerging markets, and they're both trading cheap relative to historic norms. They both appear to be more powerful than the historical evidence would suggest. In both cases, momentum is a very powerful factor, with the caveat that it's high turnover. Small cap is an interesting factor, but not statistically significant. But good gracious, what happened to illiquidity? Not much there. Low beta looks pretty good, but gee, does it look pretty good because it's gotten more expensive? This would certainly seem to support that. And gross profitability looks to be interesting in emerging markets, but not in developed ex-US. Now, believe it or not, a test going back to 1982 or back to 1996 is not a long span. So I would view these as indicative results, not a basis for huge bets, but a basis for being sensitive to what's cheap and what's not cheap. We saw this graph earlier. This is value versus growth in the U.S. Well, the international relationship is awfully similar. In fact, there's no statistically significant difference between those two diagonal lines. Emerging markets, similar. Over a relatively short span of 20 years, there's no statistical significance to the difference between that line and the other 2 lines. But all 3 are trading cheap relative to history. Emerging markets are trading very, very cheap relative to history. Boy, that's interesting. You blend all 3 sets of data and have a pooled regression, this is the fit that you get. Now, whether that fit is applicable to each of these 3 domains, U.S., developed ex-U.S., and emerging markets, that's something that people can debate at will. The fact that it's downward sloping is undeniable. The fact that current valuations for value strategies are cheap relative to history, undeniable. And in emerging markets, they're trading so cheap that no matter which of the three lines you're using, it looks like value should beat growth by 10 or 20% per annum over the next 5 years. That's pretty powerful. This is why we've been pounding the table on fundamental index in emerging markets and generally deep value strategies in emerging markets. They appear to be trading very cheap. So if we add in the developed ex-US bars to the graph we looked at earlier and the emerging markets bars, we can see some common themes. The popular low-vol strategies are popular because they have tremendous historical returns. How much of that tremendous historical return came from rising valuation multiples? Undoubtedly, some of it came from rising valuation multiples. Are those strategies now in the top decile of historical valuations? Yes, they are in the U.S., in developed ex-U.S., and in emerging markets. Profitability, a mixed picture, expensive in the U.S. and in EFA, not so much so in emerging markets. Momentum, currently trading expensive in all three domains. And values at or near the bottom decile of relative valuation in all three markets. Now, smart beta isn't just factors. There are also strategies. We looked at a half dozen popular strategies in smart beta land: equal weight, fundamental index, risk efficient, low vol index using the S&P methodology, maximum diversification, quality index using the MSCI methodology, and all six work. Isn't that wonderful? Well, of course, you never see a back test on anything that doesn't work. But it turns out that equal weight, once you extract changes in valuation multiples, statistical significance goes through the roof, and you wind up with 99% significance. Fundamental index winds up looking pretty solid in both cases. The other strategies have their own different responses, but low vol, very, very popular these days, has become more expensive and is therefore perhaps less powerful than people think. Viewed in terms of relative valuation, 5 of these are trading rich relative to history, 2 are trading in or near the top decile of historical relative valuations. Fundamental index, as a value strategy, is trading cheap. Current valuation ratio percentile, you've got 2 in the top quintile, low vol and maximum diversification. You've got 1 trading cheap relative to history. So in summary, we're not suggesting that investors should abandon smart beta. When we talk about how can smart beta go horribly wrong, we're not saying smart beta is a disaster. We're saying performance chasing in smart beta is just as smart as it is in manager selection, in stock selection, in asset class selection. Performance chasing is a disaster. We are suggesting that investors look before they leap. Strategies with wonderful 3, 5, and 10-year performance. Ask the question, is this now expensive? Did it win by dint of becoming more expensive? Today, most factors are expensive relative to their historic norms. For 2 of them, low beta and gross profitability, the factor premium looks to be awfully close to 0, net of valuation changes historically, and they're trading rich now. On the other hand, value strategies and value-related smart betas are cheap relative to their history. While they typically, in most cases, had an awful year last year, what a great time to consider committing some assets to these deep value strategies. Thank you very much for your time.
Thanks, Rob, for that insightful presentation. Now is the portion of the webinar where we'll move into questions and answers. And it looks like we've already received 65 questions, so thank you very, very much. Many of these echo similar themes. So I think I'll start with probably the most common one we've gotten over the past couple of months. Research Affiliates has long been a leader in smart beta. Do your recent comments indicate a change in your core convictions?
Absolutely not. Part of this hinges on the definition of smart beta. Smart beta originally meant strategies that were objective, mechanistic, historically testable, transparent, low fee, low turnover, spanning the broad macroeconomy, and most important of all, strategies that severed the link between the price of a stock and its weight in the portfolio. Well, this would include strategies like fundamental index for sure. That was actually the catalyst for Towers Watson coming up with the smart beta label in the first place. Equal weight, minimum variance, low vol. These are all strategies that sever the link between price and the weight in the portfolio. The label has since become attached to just about anything. And if the label means anything, then it means nothing. So I take minor issue with the notion of attaching the label smart beta to factor tilt strategies, because most factor tilt strategies start out with cap weight. That doesn't sever the link between price and the weight in the portfolio. And starting with cap weight, you put on a bit of a tilt. So in most cases, you still have a stark linkage between price and the weight in the portfolio. I don't view that as smart beta. The marketplace does. So I view smart beta is still an interesting idea, an interesting set of investment tools. All we're saying is look before you leap. You see a wonderful historical performance for some new smart beta strategy. Take a look. Did it win by dint of getting more expensive? And is it trading richly now relative to its own history? If so, put a Post-it note on that strategy to take another look in 3 years. See if it's cheap then.
Cliff Asness of AQR recently published a paper, The Siren Song of Factor Timing. Can you comment on some of the assertions made in that piece and how it contrasts or agrees with some of this research?
Sure. I think Cliff and I have far more areas of agreement than disagreement. I'm not sure he would even agree with that statement, but never mind that. Our paper was a white paper, not a journal article. So firstly, I view Cliff's feedback as not unlike a referee report. Wonderful feedback on how people can take the ideas that we introduce and do them a little better. I think that's neat. Secondly, I'd observe we have no dog in this hunt. We don't have a multi-factor strategy. We did this purely because we saw a whole flurry of multi-factor strategies coming out on the marketplace. And those multi-factor strategies, some of them were gaining attention because they were becoming very expensive. That had us alarmed that people might be at risk of making serious mistakes. Cliff says that the siren of factor timing, aggressively chasing whatever factor is cheap, is dangerous. I agree. My article addresses the sirens that are on the opposite shoals. Aggressively chasing whichever factors have the best recent performance, I would say, is even more dangerous than Cliff's sirens. He agrees that performance chasing is dangerous, but I have the impression that he thinks that wasn't my main point. Cliff says that modest factor bets are okay. In his parlance, he describes this as sinning a little, but that I'm advocating big factor bets. I'm not, except in one context. Cliff says that factors with strong past performance should not be dismissed merely because they've risen in relative valuation. I agree, with the caveat that factor selection can itself be a form of performance chasing, which is dangerous. So I would be much more willing than Cliff to shun factors that have become very expensive and have performed well largely by dint of becoming expensive. Cliff says that a 5-year regression on the momentum factor returns are ridiculous because of its high turnover. I agree. Our paper, we cautioned against using 5-year regressions for strategies that have the highest turnover. Cliff thinks that we're engaged in histrionics when we use terms like smart beta crash and horribly wrong. I don't agree. If you buy a set of strategies thinking that historical 4% alphas are likely to be achieved in the future, and you wind up getting minus 4%, oh my goodness, that's That's smart beta going horribly wrong. And if enough people pile into these strategies, that's a smart beta crash in the strategies that has become suddenly popular and suddenly expensive. So we stand by our paper, but we also are grateful to Cliff for providing some very direct feedback on areas where we might have been less clear than we could have been.
Rob, this is the last question that we'll have time for. What are some of the telltale signs of an expensive smart beta strategy?
Take a look at relative valuation. Doesn't matter whether you use Shiller PE or price to book or price to sales or dividend yield. Look at it relative to its historic norms. I'd even go further than that and say you can use this same methodology not just on factor tilts, not just on smart beta strategies, but you can probably use this same technique on mutual funds at large, on active managers. Ask the question, is this strategy trading at historic peaks of relative valuation? Anything that's newly expensive at peaks of relative valuation has two interesting attributes. One, it will have performed beautifully in the past, and two, it'll probably perform badly in the future. Watch out. If it's a really interesting strategy, put a Post-it note on it, a reminder to come back and take a look in 3 years. And if it's trading cheap at that point, then make an informed decision whether you want to proceed.
Thank you very much, Rob. We're coming up on our time. We want to give you a few notices. Obviously, if we had 65 to start, we got through 3 questions, so that still leaves 62 more. The team at Research Affiliates will be answering these unanswered questions and getting those out. I also like to remind you that we will be publishing, as Rob mentioned, Part 2 of this research, where Rob and his colleagues, Vitaly Kolesnik and Noah Beck, will be covering some of the things that he briefly touched upon. Also, a replay of this webinar will be available on researchaffiliates.com in the next couple of days, probably early next week. If you're on our mailing list, you'll be notified when these materials become available. For those of you who have not yet subscribed and would like to be on the mailing list, we certainly encourage you to sign up on our website, researchaffiliates.com. And lastly, before you go, we always appreciate your feedback. We say at Research Affiliates that feedback is a gift, good, bad, constructive, or otherwise. If you wouldn't mind spending the last minute of our time together filling out a short 1-minute survey that will appear on your screen, we greatly, greatly appreciate it. Thank you again for joining us today. We hope you found the discussion insightful.
Thank you all for your time.